Right before financial systems collapse, they often look invincible. Markets surge, wealth multiplies, people feel smarter than ever. And that's exactly when the danger becomes hardest to see. The strange thing about financial collapses is that they almost never begin during moments of fear. They begin during moments of maximum confidence. Stock prices rise aggressively, credit flows easily, companies report record profits, ordinary people start believing prosperity itself has become permanent. That illusion is what makes bubbles so dangerous. Because when everyone around you appears to be getting richer, caution starts feeling irrational. Before the 2008 financial crisis, banks approved mortgages at an astonishing pace. Millions borrowed money they realistically could not repay. But almost nobody seemed worried, because home prices kept climbing higher. Every rising price reinforced the same belief. The system was safe. Wall Street turned dangerous debt into safe investments and sold them across the world. Ratings agencies approved it, television celebrated it, and almost nobody realized the financial system was quietly poisoning itself underneath the surface. But this is where the system changes. The more confident markets become, the more invisible risk starts feeling. Investors stop asking whether prices actually make sense, because recent success becomes the only evidence they care about. Institutions become comfortable taking on leverage because growth appears predictable. Governments ease pressure because rising markets create political stability. Slowly, the entire financial system begins depending on one dangerous assumption, that tomorrow will continue looking like today. And this is the part most people never notice. Financial collapses are rarely caused by one giant mistake alone. They emerge when thousands of small risks quietly accumulate underneath periods of optimism. Money starts multiplying faster than reality itself. Banks borrow more aggressively. Hedge funds amplify exposure through leverage. Consumers finance lifestyles through cheap debt. Entire industries become dependent on borrowed growth just to maintain the illusion of prosperity. And because the economy still looks strong from the outside, almost nobody questions how fragile the structure is becoming underneath. For a while, the bubble looks intelligent. That's what makes it lethal. The same pattern appeared before the dot-com collapse in the late 1990s. Investors poured billions into internet companies with no profits because technology hype convinced people the old rules no longer applied. Companies doubled in value overnight simply for adding .com to their names. Experienced investors who warned about valuations were mocked for not understanding the future. And for a while, the optimism looked justified, because prices kept climbing. Then something strange happened. People stopped caring whether investments made sense. Success changed human behavior. The longer markets rise, the more aggressively people chase returns. Speculation stops feeling risky and starts feeling intelligent. Entire societies become emotionally attached to growth itself. Then the culture changes. Suddenly everyone knows someone making easy money. Friends become investors overnight. Social media turns speculation into status. Taxi drivers start giving stock tips. Teenagers begin trading leveraged assets from their phones. People who never cared about finance suddenly become obsessed with charts, trends, and overnight wealth. At that point, the bubble is no longer driven by fundamentals. It's driven by belief. And belief is powerful. A system can stay irrational long enough to convince millions that the danger was never real in the first place. But confidence creates another hidden problem inside financial systems. Liquidity dependency. Banks, institutions, and markets begin relying on constant borrowing and continuous inflows of money to sustain asset prices. As long as optimism remains strong, the cycle keeps expanding. But once confidence weakens, even slightly, the system becomes vulnerable to repricing. Debt becomes harder to refinance. Investors rush to reduce exposure. Institutions stop expanding risk and start protecting themselves. And what once looked stable from the outside begins cracking underneath the surface. That's why the first real warning sign before almost every financial collapse is not panic. It's the disappearance of caution. The moment people collectively begin believing serious collapse is no longer possible, the system has usually already become far more fragile than anyone realizes. Once confidence takes over a financial system, money itself starts behaving differently. Borrowing becomes cheap. Credit becomes easy to access. And suddenly, risk stops feeling dangerous because the entire economy begins rewarding aggressive behavior. This is usually the phase where bubbles quietly accelerate beneath the surface. Central banks lower interest rates to stimulate growth. Banks expand lending. Massive amounts of liquidity flood into markets searching for returns. At first, the effects look overwhelmingly positive. Companies expand rapidly. Hiring increases. Asset prices explode upward. Consumers spend more freely. Wealth appears to multiply almost everywhere at once. But this is where the hidden mechanism begins. Cheap money changes how people calculate risk. When borrowing costs remain low for years, investors stop focusing on sustainability and start focusing on momentum. Hedge funds increase leverage to amplify profits. Corporations take on enormous debt because financing feels almost free. Retail investors pour savings into speculative assets because conservative returns suddenly feel too slow. And slowly, the system becomes addicted to easy liquidity. That addiction matters more than most people realize. During the housing boom before 2008, banks issued enormous numbers of subprime mortgages to borrowers with weak credit histories because rising home prices made the loans appear safe. Those mortgages were bundled into complex financial products and sold globally to investors desperate for higher yields. As long as housing prices continued climbing, the machine kept functioning. Profits increased. Confidence expanded. And institutions convinced themselves risk had been eliminated through financial engineering. But the risk never disappeared. It was simply distributed across the system in ways most people didn't fully understand. And this is the part most people never notice. Easy money doesn't just inflate prices. It changes human behavior at every level of the economy. Investors stop asking whether assets are fundamentally valuable because rising markets make almost every decision look intelligent. Speculation replaces discipline. Companies that should fail continue surviving because cheap debt keeps them alive. Economists call them zombie companies. Businesses generating just enough income to survive, but not enough to remain truly healthy long-term. The longer liquidity floods the system, the more fragile the structure becomes underneath. The same pattern appeared during major crypto booms. Trillions of dollars entered speculative digital assets, fueled by near-zero interest rates and stimulus-driven liquidity. Coins with little utility skyrocketed in value simply because investors believed prices would keep rising. Venture capital firms poured money into projects with weak fundamentals because momentum itself became the strategy. And while prices climbed, skepticism almost disappeared completely. Anyone questioning the bubble was mocked for missing the future. But bubbles built on liquidity contain a dangerous weakness. They require constant inflows of new money to survive. The moment borrowing becomes more expensive, or confidence slows, asset repricing begins. Suddenly, leveraged investors are forced to sell positions. Institutions tighten lending. Capital retreats towards safer assets, and what once looked like unstoppable growth begins revealing dependency. That dependency is what makes easy money eras so deceptive. Low rates encourage leverage. Leverage inflates asset prices. Rising prices create confidence. And confidence encourages even more borrowing. It becomes a self-reinforcing cycle. Until one day, the cost of money changes, and the entire structure realizes it was standing on borrowed stability the whole time. There's another pattern hidden inside every financial bubble that almost nobody notices while it's happening. The longer the boom survives, the more normal the madness starts feeling. This is the stage where phrases like "this time is different" begin spreading everywhere. Investors convince themselves old financial rules no longer apply. Economists invent explanations for why growth can continue indefinitely. Ordinary people begin treating rapidly rising prices as completely normal. During the dot-com bubble, Many investors believed internet companies no longer needed profits because technology itself would supposedly change business forever. Before the 2008 crisis, millions believed housing prices could never fall nationally. During crypto rallies, speculative coins with almost no utility reached enormous valuations because hype itself became the fuel. Every era creates a different story, but the emotional structure underneath never changes. Fear disappears from the market. Greed replaces caution, and the more prices rise, the more emotionally attached people become to the idea that growth itself is permanent. That psychological shift matters because markets stop functioning rationally during late-stage bubbles. Prices rise not because assets become fundamentally stronger, but because investors believe someone else will buy them at even higher prices later. That belief can survive much longer than logic should allow. And because speculative behavior keeps getting rewarded during the boom, skepticism becomes socially unpopular. People warning about danger are dismissed as pessimists. Conservative investors underperform. Risk managers get ignored. The crowd starts believing caution itself is outdated. Then eventually, reality begins catching up with the illusion, and this is where everything changes. Financial collapses rarely begin with one giant explosion. Most of the time, they begin with something small enough to ignore. A single bank reports unexpected losses. A few borrowers stop making payments. Liquidity tightens quietly inside a corner of the market most ordinary people barely understand. At first, these events look temporary, manageable. Analysts call them isolated problems. Investors continue buying because confidence still dominates public perception. But underneath the surface, the system has already started changing. Modern financial markets are deeply interconnected. Banks lend to other banks. Hedge funds borrow heavily from institutions. Corporations refinance debt continuously to survive. And because leverage spreads throughout the entire system, even a small disruption can create pressure far beyond the original problem. That's what makes financial systems so fragile during bubble periods. Stability depends on everything continuing to function perfectly at the same time. And this is the part most people never notice. Leverage doesn't just magnify profits during booms. It magnifies instability during downturns. A hedge fund using borrowed money may only need a small decline in prices before lenders demand additional collateral. If the fund cannot provide it, positions are liquidated automatically. Those forced sales push markets lower. Lower prices create losses elsewhere. And suddenly, what started as a small disruption begins spreading mechanically through the system. That chain reaction was already happening before most people realized the 2008 crisis had become dangerous. The collapse did not begin with the global economy failing overnight. It started quietly inside the US housing market. Borrowers with weak credit histories began defaulting on mortgages at higher than expected rates. At first, Wall Street treated the problem as manageable, but those mortgages had been transformed into complex securities owned by banks and institutions around the world. And once defaults increased, nobody fully understood where the risk was hiding anymore. Suddenly, banks stopped trusting each other. Credit markets tightened. Liquidity vanished. Institutions started protecting themselves instead of expanding risk. That's when fear entered the system. And fear moves through financial markets differently than confidence. Confidence grows slowly. It can take years of rising markets and economic optimism to convince people the system is safe. But panic does not need years. Panic can spread globally in hours. Because once investors believe conditions may become unstable, survival instincts start overpowering logic. Investors rush to sell assets. Banks tighten lending standards. Companies freeze expansion plans. Consumers reduce spending. Every reaction creates pressure somewhere else in the economy, and financial collapses become self-reinforcing. Falling prices create stress. Stress triggers forced selling. Forced selling pushes prices lower. Lower prices create more panic. The cycle accelerates itself. During the Great Depression, thousands of Americans lined up outside banks trying to withdraw savings before institutions failed entirely. Ironically, Those withdrawals accelerated the failures people feared most. The same emotional structure still exists today. Modern crypto crashes revealed how quickly confidence can evaporate inside highly speculative markets. Once prices started collapsing, investors rushed toward exits simultaneously. Exchanges faced liquidity pressure, billions in paper wealth disappeared within days, and the same psychological reversal appeared again. Optimism transformed into survival. That's why crashes accelerate much faster than booms. Growth depends on confidence building gradually. Panic only requires one thing: the belief that everyone else may panic first. And once that belief enters the system, markets stop behaving like rational machines. They start behaving like crowds.